How to incorporate machine learning in cryptocurrency trading. Introduction. Cryptocurrency trading has grown exponentially over the past decade, attracting a diverse group of retail and institutional investors. The allure of substantial profits comes with the challenge of navigating a highly volatile and often unpredictable market. Traditional trading strategies can fall short in such a dynamic environment, making the integration of advanced technologies like machine learning, ML, increasingly attractive. Machine learning offers a way to analyze vast amounts of data, identify patterns, and make predictions that can significantly enhance trading strategies. However, incorporating ML into cryptocurrency trading is not without its challenges. This video aims to address these challenges by focusing on three critical aspects: leveraging crypto-specific data, being wary of market sentiment, and adapting quickly to market changes. By understanding and implementing these strategies, traders can significantly improve their chances of success in the crypto market. Aspect 1. Leverage crypto-specific data. Machine learning models thrive on data, and the cryptocurrency market offers unique datasets that can provide valuable insights. Unlike traditional financial markets, the crypto space is rich with diverse data types that can enhance predictive accuracy. On-chain data analysis. On-chain data refers to information that is directly recorded on the blockchain, providing a transparent view of the market's internal mechanics. This data includes transaction volumes, wallet addresses, and mining statistics. For instance, a spike in new wallet addresses might indicate increased interest in a particular cryptocurrency, which could precede a price surge. By training ML models on this data, traders can identify emerging trends and make informed decisions. Example 1. Transaction volume analysis. Transaction volume can be a significant indicator of market activity. By analyzing transaction patterns, ML models can predict potential price movements. For example, a sudden increase in Bitcoin transactions might signal a forthcoming price rise, prompting traders to buy in anticipation. Example 2. Mining data insights. Mining data, such as hash rates and mining difficulty, can provide insights into the health and future prospects of a cryptocurrency. A decreasing hash rate might indicate reduced miner confidence or operational issues, potentially leading to a price drop. By incorporating this data into ML models, traders can gain a deeper understanding of market dynamics and adjust their strategies accordingly. Social media metrics. Cryptocurrencies are heavily influenced by social media activity. Platforms like Twitter and Reddit can provide a wealth of data regarding public sentiment and trending discussions. Analyzing tweet volumes and sentiment scores about specific coins can help predict price movements. ML models can process these vast amounts of unstructured data to uncover patterns that might not be immediately apparent through traditional analysis. Example 1. Twitter sentiment analysis. Tweets can significantly impact cryptocurrency prices. Analyzing the sentiment of tweets mentioning a particular cryptocurrency can provide early indicators of market direction. For instance, a sudden surge in positive tweets about Ethereum might suggest an impending price increase, allowing traders to position themselves advantageously. Example 2. Reddit discussion trends. Reddit is another platform where cryptocurrency discussions are prevalent. By analyzing the volume and sentiment of posts in crypto-related subreddits, traders can gauge market sentiment. A spike in discussions about a new altcoin might indicate growing interest and potential price appreciation. ML models can continuously monitor these discussions, providing real-time insights that help traders stay ahead of market trends. Aspect 2. Be wary of market sentiment. The cryptocurrency market is highly susceptible to changes in sentiment, which can be swift and extreme. Understanding and predicting market sentiment is crucial for effective trading. Sentiment analysis on news articles. Natural language processing, NLP, techniques can be used to analyze the sentiment of news articles and blogs. For instance, a sudden influx of positive news about regulatory acceptance of a cryptocurrency can boost its price. Conversely, negative news such as security breaches can lead to a price drop. ML algorithms can continuously scan and analyze these news sources to provide real-time sentiment scores, helping traders anticipate market moves. Example 1. Positive news impact. When China announced it was exploring blockchain technology, cryptocurrencies with strong ties to China experienced price surges. By using NLP to analyze news articles for positive sentiment, traders could have anticipated these price movements and capitalized on the trend. Example 2. Negative news reaction. News of security breaches, like the hacking of a major exchange, often leads to sharp declines in cryptocurrency prices. An ML model trained to detect negative sentiment in news articles can provide early warnings, allowing traders to mitigate losses by selling off vulnerable assets promptly.
Social media sentiment tracking.
Beyond general sentiment analysis, ML models can track sentiment specifically on social media platforms. For example, the correlation between Bitcoin prices and tweet volumes has been studied extensively. By implementing models that monitor and analyze real-time social media sentiment, traders can gain early warning signals of potential market shifts, allowing them to react more swiftly than their competitors. Example 1. Viral trends. A sudden viral trend, such as a prominent influencer endorsing a cryptocurrency, can lead to rapid price increases. ML models that monitor social media platforms for mentions by key influencers can provide traders with actionable insights, enabling them to take advantage of these trends early. Example 2. Community sentiment shifts. Changes in sentiment within cryptocurrency communities can also impact prices. For instance, increasing skepticism within a community about a project's viability might precede a price decline. By analyzing sentiment within forums and social media groups, traders can adjust their positions to avoid potential losses.
Aspect 3. Adapt quickly.
The fast-paced nature of cryptocurrency markets requires trading algorithms to be highly adaptable. Traditional financial models often fail to keep up with the rapid changes seen in crypto markets.
Reinforcement learning for dynamic strategies. Reinforcement learning, RL, can be used to create trading strategies that adapt based on market conditions. Unlike static models, RL algorithms continuously learn and adjust their actions to maximize returns.
For instance, an RL model can be trained to optimize a portfolio by dynamically reallocating assets in response to market changes, thus providing a robust solution in a volatile environment. Example 1. Portfolio rebalancing. An RL algorithm can be designed to rebalance a cryptocurrency portfolio in real time, adjusting asset allocations based on market performance. This dynamic approach ensures that the portfolio remains optimized for maximum returns, regardless of market conditions. Example 2. Risk management. RL can also be used to develop advanced risk management strategies. By continuously learning from market data, an RL model can identify potential risks and adjust trading strategies to minimize exposure. This proactive approach helps traders protect their investments in a highly volatile market.
Real-time data processing and model updating.
To remain effective, ML models need to process real-time data and update their predictions accordingly. Utilizing frameworks that support real-time data ingestion and analysis, such as Apache Kafka and TensorFlow, traders can ensure their models are always operating with the latest information. This capability is crucial for making split-second decisions that can significantly impact trading outcomes. Example 1. High-frequency trading, HFT. High-frequency trading relies on processing vast amounts of data in real time to execute trades within milliseconds. By incorporating real-time data processing capabilities into ML models, traders can develop HFT strategies that capitalize on market inefficiencies, leading to substantial profits. Example 2. Continuous model training. Continuously training ML models on the latest market data ensures they remain accurate and effective. By setting up automated pipelines for data ingestion and model training, traders can keep their models up to date, allowing them to respond to market changes with precision. Conclusion. Incorporating machine learning into cryptocurrency trading can provide a substantial edge in an unpredictable market. By leveraging crypto-specific data, being mindful of market sentiment, and developing adaptive algorithms, traders can navigate the complexities of the crypto space more effectively. As the market continues to evolve, so too must the strategies employed by traders. Embracing these advanced techniques can lead to more informed decisions, better risk management, and ultimately, improved trading performance. By staying ahead of the curve and continuously adapting to new data and trends, traders can achieve long-term success in the ever-changing world of cryptocurrency trading.
Happy trading!